Everyone, welcome to a new episode of Investing Fool. The markets have taken quite a beating this week, and it seems like in the last 4 months we haven't really gone anywhere in terms of the market. But recently we have started correcting quite a bit, and it doesn't seem like the downside is stopping anywhere as of now. So we'll try to look at the markets, the indices, our portfolio, some charts in this video, and try to put all that in context. I'll try to keep the video short, but अगर लंबा हो जाए तो यार fast forward में देख लेना. So let's begin. As usual, the disclaimer that please do your own due diligence before investing anywhere. These are just for illustration purposes. So let's get started. So in terms of the major indices, we have Nifty 50 here, Nifty 500, mid caps and small caps. Nifty next 50 is not here, although the pain in Nifty next 50 is much more than Nifty 50. But overall, if we look at Nifty 50, 500 and mid cap, they are somewhere around 10 to 11% down from the top. The only index that has been kind of least hit in this scenario is the small cap. So it's down around 9% from the top. But here we might think that like small caps is one segment. So earlier what was happening is that the large caps were taking a lot of beating because FIIs were selling continuously, and FIIs hold mostly large caps. They do not invest that much in mid caps and small caps. So the large caps were taking a beating while the mid caps and small caps were showing the resilience. Now in the past couple of days, what we are seeing is that the mid cap and small caps are falling more compared to their large cap counterparts. So this could be a time where sort of a trend reversal takes place, because it cannot happen that the large caps will continue underperforming for like long periods of time and the small caps will continue outperforming. Somewhere those curves have to meet and talk to each other, right? So small cap, it might be that time when small caps start those trend reversal, and if that happens, like if small caps start underperforming once and it accelerates, the pain could be much more than what we typically see in large caps. If we look at momentum indices, so here we are looking at Nifty 200 momentum 30. Actually, we are not looking at the index, we are looking at an ETF. I've taken an ETF from the HDFC AMC as the proxy for this index. So this ETF, which is HDFC Movement, tracks the Nifty 200 Momentum 30 passive index, which is created by NSE. And bear in mind that this index has an annualized return of over 20% in backtests over the long term, and in calendar year 2024 it had actually given like almost 20% if we take from Jan to December. But with the recent correction where we stand now, if we look back, we are at the same place where we were in mid of Feb 2024, and mid of Feb 2025 is just a month away, right? So almost 11 months we have had like absolutely no gain in this ETF, and you can see the fall from the top much more than the larger indices, right? This is 17.5% from the top. And one more thing to remember is that these indices are rebalanced every 6 months, right? So even if some non-performing stocks are there, even if that realization has dawned on the index, they will not be making any changes till the next rebalancing, which like the time period for that, the frequency for that is 6 months, right? So that's quite a bit of time to stick with stocks, but with the kind of market that we are in, even a churn or even a refreshing doesn't help, because everything is kind of falling. It doesn't matter whether you're a momentum investor, value investor, growth investor, quality investor, whatever type of investor you are getting beaten black and blue. Some sectors might save the grace someday, like IT did today, but overall most portfolios are down, and most portfolios are actually much down compared to the index. You can also see here that the 50 DMA has crossed below the 200 DMA for this particular index, for this ETF, and that's never a good sign. It has a very high likelihood of indicating that further pain is in order. Okay, so let's start the discussion, and we'll take a look at the portfolio as well and some stocks. So there are multiple factors that have recently come up, and there's so many moving pieces. There are so many things that are going to come in the next couple of months, whether it's Trump, whether it's budget. Our GDP numbers have come out like pretty horrible, so we have sluggish macro, so that doesn't support. We have poor corporate earnings, so that doesn't support either. Whether the tariff, what will the impact of the tariffs that Mr. Trump puts up on different countries and on different global chains, and how India is going to negotiate that. So that is another concern. The high bond yields and the strengthening dollar on the US side isn't helping either, leading to continuous outflows from the emerging economies, including India. The rate cuts, as they were expected, now we have almost priced in that there will probably be like two rate cuts in 2025. In India, I'm not sure whether we are going to see even one rate cut. From the RBI side, because inflation is sticky everywhere. So all these factors have conjured up this kind of a mess that we find ourselves in, and so many risks are visible to investors worldwide. And worldwide, it's not that big of a deal actually, because US markets haven't corrected this much. It's the Indian market. Considering the pedestal where they were, right, in terms of valuations, and considering the kind of earnings that we'll see, probably in FY25 we are going to see like 7-8%, maybe. So what the bulls will think is that if we just don't fall from here, right, if we could just give us some peace, just let us rest here without going to 22,000, 21,000, that would be like that would be a very welcome proposition for all the bullish investors. And personally, I feel like, overall I feel that we are not going to go below 22,000, but this is not this is just a personal hunch, right? We are not in the business of forecasting. We will, like, our strategy will probably take care of whatever the market brings. So current drawdown, when we talk about our portfolio, we have actually hit a max drawdown. So the earlier max drawdown were around 14.4%. Current the drawdown is 15.3%. So we have fallen like 15.3% from the top. We have lost all our gains relative to the underlying index, which is the Nifty 500. So let's take a look at the portfolio. Okay, so in the portfolio, while on an absolute basis we may still be above the index, but if we like take into account taxes and transaction costs and everything, we have actually today hit below the market. Till yesterday, till end of day yesterday, we were still having some gains, and you can see the a full sea of red here. Like only one stock, Lloyd SME, was green. Okay, Coforge was another because in the IT pack, but then there were another two stocks in the IT pack which didn't perform for us. First Source here down 4.2%. OFSS, this has been disappointing for quite some months now, but it still remains in the momentum ranks. That is down 2.3%. So and you can see the many of the high weight stocks that have been in the portfolio for long, right? Trent ho gaya, Zomato ho gaya, Kalyan ho gaya, they have fallen quite a bit. Trent had actually recovered. We can look at the charts in some other video, but Trent had recovered to almost a 14%, 13% drawdown from the top. It had fallen almost to 25%. Then it had slowly started inching up higher, and then again in the recent correction, it has dropped below 20%. And you can see Dixon was at an all-time high, down 13%. Kalyan is down 21.4%. We'll discuss about Kalyan. Zomato has lost quite a bit, has taken a severe beating in the last few sessions. And today it was the market was a bit generous to Zomato, probably because it has taken so much of beating earlier itself. We can see like Glenmark, Jubilant, all these, like even the pharma stocks were not spared today, even though we call them a defensive sector. Piramal down 6.6%. We have DOMS, this is FMCG, down 4.7%. K-Fintech down 5.1%. So no hiding, no saving grace. And you can look at the portfolio level PE as well, although we do not use it for any entry exit decisions. So portfolio PE is was around 145 again, 144, 145 a few days ago. Then we started correcting. It has nosedived again. The average gain for winners today, you can see only these two stocks. That's around 1.39%. But look at the average loss. So on average, a losing stock has lost 3% today, and the portfolio as a whole has lost 2.3%, while the market has lost just 1.1%. So this is always a risk that when such kind of swift falls happen, momentum portfolios would correct much more than the underlying index, right? So that is something that we should always keep in mind. In terms of sectors, again we see pain all around, reds all around. Nifty IT is the only one saving grace here. If we look at the last 10 days here, let's look at the stocks. Okay, we can see that like almost no stock, right? So except Lloyd SME, which is which has gained around 10% in the last 10 days, in the last 10 sessions, we haven't like seen any other stock. Most of them have been just trending downwards. So you can see all the stocks have been bunched up here. They have been trending downwards, and we do not know where this is going to stop. Okay, so as I said, post tax and post returns, we have post tax and transactions, we have lost all of the gains related to our benchmark index. And while we started this portfolio somewhere in like 2023, at the end of 2023, for someone who has come in recently, like last 3 months, last 6 months, they would have been battered, and they would have been frustrated by the kind of performance that they would have seen, right? So it's a very painful period. It's a very trying period for someone who has started investing like 6 months back, or even just a year back. Uh, but that is to be expected. So we cannot, there will always be a starting point bias in your portfolio, but these things do not last. So the good times also do not last very long. The bad times also do not last very long. If we even go to a technical definition of like bear market, which is like 20% fall from the top, even if we go there, there is a high likelihood that in 12 to 18 months we should be able to recover. So let's give or take 1 to 2 years max, we can take. No bear market phases actually last beyond that, but whether the investors have the patience to last that much time in the market, that's a different thing. That's where psychology and mindset comes in. Okay, so you saw that indices may have fallen 10 to 15%, 10% actually, but the real pain is in the portfolio stocks. Your portfolios, and this is for everyone, like your portfolios, you would have seen they have fallen much more than the indices. Okay, trend reversal for mid and small caps we already talked about. The next point is that okay, more downside is likely. The times are not looking good. They're not looking great as of now. But whenever the economic cycle recovers, so whenever there are the first signs, and you won't even get the first signs, so market will always try to front run it. So market will start going higher before the actual indicators or even the rumors of those indicators start trickling into public view, that okay, maybe the economy has bottomed out, and maybe after like 2-3 quarters we will start inching higher. The market will, whenever that recovery happens, whenever the eventual economic recovery happens, market will anticipate it and price in much earlier, and the recovery in the market will precede that in the actual economy. Okay, gold recently has again come back. It's still like okay, I've not noted the number here, but it's still below, much below the all-time high, but still inching higher. So it has I mean, it has not gone down like it was going down a few days ago. So at least in this period when equities have corrected, gold has provided a little bit stability to most portfolios who would be holding significant proportions of gold. Okay. Now there are a few more factors. The first is that this time, like if more downside comes, right, and let's assume that we are going to correct further 5% or whatever, right? So this will mean that a natural pruning of the market will happen, and this is for stocks, for example stocks that have run up too much, right? Their valuations would somehow come to more saner levels, at which point some buying may be possible for investors who are of a different bent. Like for example, everyone invests according to their style of investing, right? Typically momentum investors would not wait for valuations to cool down, right? We don't have anything to do with that, I mean, while in terms of the entry decisions. But for other investors, for fundamental investors, there are like endless ways of investing in the market. For a large number of investors, when the valuations come down, they seek some comfort, and that might start a cycle of a fresh bout of buying. So for stocks, this pruning period that I'm talking about, so stocks that are overheated, that have gone too high too soon, they will get time to consolidate, to correct, and to gain some stability, to gain some footing from where they can probably go up. And many stocks might like lose everything and just keep going down, 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 may never recover, right? But the second point is that for investors as well, this is a trying period, but it's a good period to take some learnings, and to show your resilience and patience. A lot of investors will leave the market right now, so they will come, like for example, if you've come in the last 6 months, you've seen a lot of losses all around, right? Every time you're trying to attempt a new breakout, nothing is happening, you're again losing money, stop losses are getting hit, right? And you are having to exit. So all you see is red, 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 and then you decide, okay, enough for me, I'll go out, I'll sit out, I'll try to come when things are better. Many of those investors may never come back into the market. Many may have suffered significant losses as well, right? So it can happen. So this is a natural pruning of investors as well. It shows the mindset, like some investors who would have the mindset and the tenacity to continue investing, staying invested in the markets, they will continue, they will see through this period, and when the upside comes, they will be ready to clinch that upside. So you have to be in the market to capitalize on the upside whenever it comes. You cannot be sitting out of the market, right? And that is why the second point related to that is that cash calls are very tricky. So first of all, like in our portfolio as well, it is likely that this time in the next rebalancing, which is going to happen on Wednesday, I think 15th, that we may not add new stocks, because currently the equity curve, 200 DMA is below our equity curve, and the Nifty 500, which is benchmark index, that like the 200 DMA for that index is also the index is below the 200 DMA, right? So from both curves are below their 200 DMA, and that is the condition that we set, that we may not take new positions. But this call is also very, very tricky. This is the only part of the strategy where I feel like there is no real right answer, because what happens is that the markets can continue like hovering around the 200 DMA like trend line for long periods of time, right? They can just continue going sideways. So whenever you will probably move to a bit of cash if you have sold some stocks, but you've not entered any new stocks because it was below the 200 DMA. Now there is some bit of recovery. Now part of your capital was not present there to take advantage of that recovery. That part again gets deployed when you come above the 200 DMA, but again the market really doesn't go much higher than the 200 DMA, right? It doesn't recover, but again it crosses below. So in that kind of a situation, this churn would be like too high. You will keep getting in, out, in, out, in, out, in, out. Nothing will keep happening. Every time you will get in the hope of a breakout, there would be some sort of, again, some consolidation, some weakness. You will hit stop losses, you will partly go to cash, again you will deploy that cash, again you will go to cash a few months. So this is a very, very painful period and can happen. So that's one thing. But what are you optimizing for here? You are optimizing for large drawdown. So whenever, like for example, the market doesn't come back or hover around the 200 DMA, it starts going down, 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 much down, right? Imagine like global financial crisis 2008, market was like 60% down, or COVID 30% down. In those kind of large drawdowns, uh, having like going to cash partly, fully, whatever is your strategy, that might help. but you cannot optimize for very large drawdowns which come maybe once a decade, right? Okay, once a decade such things might come, but the rest of the time the market will just, like 200 DMA is still a very very strong level to sustain, right? So the market will not go easy, like easily go much below like 20% from the top. Like something has to really break for the market to go beyond 20% from the top, right? So that's another thing. So cash calls, like whether partial, like we do partially, but whether it I mean it's a very very tricky proportion because a lot of churn could be there. But in case you completely negate that, if you want to keep fully invested रहना है, like I will do all the entries, exits, everything, the full rebalancing every time, regardless of where the trend is, right? If I follow that, then sorry, then the bad thing is that in case there is a very large drawdown, you will go down fully with the market. The good thing is that if there is not a lot of drawdown, right, then some churn might happen, but a lot of in and out because of cash may not happen. And the other thing is that your full capital will always be ready whenever the recovery happens. Your full capital is always ready to take it from the bottom, not after it has crossed the 200 DMA, right? From the bottom you are starting your recovery. So that might help that way. It is very difficult to backtest this these like partial going to call, cash calls and all that. But we'll see. I'm still a little bit doubtful about this, whether we should be adding new stocks or not in this climate. Probably I'll see one more time. We have already gone to like partial cash once, and will probably not take new stocks this time around as well. But let's see how that pans out in the future. Be ready for some hard decisions. So there could be stocks that would have given you like 150% returns, and now they're at like 80% or 90%, and you might be seeing feeling ki they like that's the bias, right? We so the I mean we can call it recency bias, anchoring, not anchoring bias, probably recency bias, maybe. If we have seen a level right recently, and we are away from it, somehow we have that number in our mind that we want it to come back to that or somewhere near that, so that we can get out, right? Shed all those kind of ideas, like whenever your strategy says get out, get out, no matter how much you love the stock, no matter how much it had given a notional gain for you, but the real gain is what will reflect on your accounts. And if you do not get out, more pain may be due. So we'll take a look at few charts. What I am doing at this point, apart from, as I said previously, continuously keep allocating to gold to keep its weight going higher. Apart from that, I'm only like buying some of these momentum ETFs below their 200 DMA, because buying these indices, if you are holding them for the long term, right, they're tax efficient and everything, and most of these indices have given pretty good returns recently. So buying them below their 200 DMA and holding them for a very very long period of time, I think that's a decent strategy. I mean, I'm not saying that it's a like market beating or it will beat all other investors, but it will give you very very it has a high likelihood of giving you very very decent tax efficient returns in the long run. So this is kind of the capital that you don't need for like 5-6 years. Okay, so you keep putting them, keep putting them, and you maybe withdraw at a much later date. Now let's take a look at two chart. So Kalyan Jewelers, as I said, has fallen quite a bit in the last few days. You can see the kind of hammering that it has taken here. Now we bought the stock around mid of March 2024. So we have seen this rally, and we were almost at 100%. The stock was at 100% gain. And somehow at this level it corrected, it tried to go back, it corrected again, it tried to go back, it corrected again, it tried to go back, and this time the correction is very very severe. So it has tried almost 4 times to breach that level. And with every correction, with every market wide correction, stocks also get corrected, but this time the correction is very very swift. Like it has gotten compressed into very few days, so there are sharp falls in just a few days. And Kalyan has fallen quite a bit. So if you see the last almost 4.5 months, Kalyan has given zero returns, right? Now let's take a look at the next stock. And quick disclaimer here: Kalyan is a part of our portfolio, as you may have already seen. And then the next stock that we are going to talk about, that is not in our portfolio. Again, no recommendation, buying, selling, anything. But that's a case in point of what could happen to momentum stocks if you do not get out when the momentum stops, right? So I can very well feel that, okay, if I get an exit signal this time for Kalyan, I might feel that, okay, this is a very very swift correction, yaar, matlab recover to kar jayega. So let me hold it. Maybe let's see 1 month or whatever. Maybe I'll move it to a long term portfolio or whatever. It will recover. Fair chance it can recover, mean reversion can happen. It can also work on the other side. How does it work on the other side? Let's take a look at the Tata Elxsi chart. So Tata Elxsi was investors darling a few years ago. Everyone was investing in Tata Elxsi, right? The stock had seen a phenomenal growth here, multi-bagger stocks, amazing run, everything, right? It kept going higher, 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 and then it fell. So someone who is taking their actual exits based on their strategy, if after falling this much, they would have gotten out somewhere here, right? And they would have saved themselves this years of pain. What has happened if you just kept holding it is, first, it can actually in the short term go much lower than whatever level you have decided for yourself. And even when it recovers, the recovery may not be consistent, right? It can just keep hovering around that same mark. You can even see Tata Elxsi now. This is October of 2021, right? This starting point is October of 2021. So uh, that is 3 years ago, more than 3 years ago, right? So for almost 3 years, and we had hit like a peak around this point as well. But almost more than 3 years, the stock has done nothing, right? And this is what can happen if you keep waiting for something to recover, right? Whether you put it in the same portfolio, whether you move it to a different portfolio, if you are sticking to a strategy, if there is a different long term investment strategy, that's a separate case. But if you're sticking to a momentum strategy, if you're a momentum investor in the strictest sense, then do not do not make such kind of calls. If something is falling and you are getting an indication to get out, then please get out. So those kind of hard decisions you would have to make, that somewhere, okay, I had gained like 200%, but now I'm having to get out at 120% or whatever. You have to get out, right? There is no two ways about it. So that's pretty much it for today. If you like the video, then please press the like button. And if you haven't subscribed to the channel, then consider subscribing. I'll see you in the next video. Till then, take care and hope for a better next week. Till then, bye-bye.